Hey guys, my name is Matt Linsner. I'm a senior accounting major here at St. Bonaventure, and I'm part of the WWE presentation team. Right now, I'm going to be doing some ratio analysis for WWE, and then later on, I'm going to be giving you guys some SWOT analysis for the WWE, and then a strategy selection from that SWOT analysis. Okay, so to start, we're going to be doing some ratio analysis. And we're going to be looking at 1 liquidity ratio, 4 leverage ratios, and 3 profitability ratios that are relevant to WWE and their 3 main competitors. Okay, so the first of 3 types of ratios we're going to look at is the liquidity ratio. And what a liquidity ratio stands to do is that it measures a company's ability to cover its normal day-to-day operating expenses. And the one liquidity ratio we're going to look at for this ratio analysis is the current ratio. And what the current ratio is simply current assets divided by current liabilities. And what that means is that it measures a company's ability to use its current assets effectively to pay off all of its current liabilities. So that good common sense tells us that a good current ratio that companies strive for is 1 or better, meaning that current assets exceed your current liabilities. So now just mulling over the current ratio for each of the 4 companies. One thing that jumps off the page immediately that is excellent news for the WWE is that their current ratio almost doubled from the prior year, going from 1.37 to 2.62, which is quite an improvement, while their competitors didn't move their ratio or their ratio decreased. Now, one recurring theme that I'd like to mention now that you'll see throughout the rest of the ratio analysis with the 3 competitors is that Cinemark's financial ratios will look very good right at the top between the 4 companies. That's due to some great financial performance over the past few years, while AMC Entertainment and Regal Entertainment will be quite the contrary. They did not do as well as Cinemark, so you'll see their financial ratios pretty similar, but kind of towards the bottom between the 4 companies. Again, I'd like to reiterate the fact that this huge jump in the current ratio is super important for the WWE, since this ratio is used as a measure of financial health and it is very widely used among companies. So again, great to see that this ratio is looking good for WWE, and it's mostly due to a $173 million increase in their cash and cash equivalents. And now that WWE has seen such a sudden increase in cash equivalents as well as prepaids and cash, we need to make sure that this cash ends up getting used productively in the business in the long run. So the second leverage ratio we're going to look at is a debt to equity ratio, and it ensures that a company is financing their operations with enough debt while at the same time increasing earnings for their shareholders. And having a ratio around 2.5 or 3, that's a good balance between financing your operations and retaining shareholder value. And by looking at the 2015 ratio numbers, it is pretty clear that the WWE is not as risky with their debt borrowings compared to the movie industry competitors. And one interpretation could be that WWE is able to be profitable without much investment from their shareholders, so that's always a good sign for most companies. And as you can see by AMC Entertainment and Regal's numbers, hovering around 4, they may be relying too much on external financing. So now by strictly looking at the 2016 numbers for debt to equity ratio, we can see that this number took a turn for the better for the WWE. They decided to embark on a long-term growth strategy, which is their main focus of 2016. And generally, these strategies require a good amount of external financing. And as WWE in 2016, they increased their convertible debt borrowings as well as borrowing other long-term debt. And this showed in the debt to equity ratio jumping from about 0.95 to 1.5. Now, a debt to equity ratio under 1 is probably not where a company wants to be. So I think for WWE, keeping this ratio around 1.5 is a nice benchmark and a good long-term goal for the company to try and sustain. So the fourth and final leverage ratio we're going to look at is net sales and net working capital, which is quite literally dividing net sales by net working capital, and that's found by taking current assets and subtracting current liabilities. So it's a company's effectiveness in taking that working capital and turning it into sales. So right off the bat, it's good to see that we're one of the 2 companies out of these 4 that has a positive working capital. That's always something to be happy about for a company. In Cinemark's case, again, strong financial performance usually indicates strong sales, which is what happened. So they were able to significantly increase their ratio. But a closer look at the WWE can change our perspective pretty quickly. So in 2015, we had a fantastic net sales and net working capital of 13.68. But as you see, in just a one-year time frame, that number drops all the way to 3.37, the largest fluctuation we saw from any ratio. Fortunately, we can explain it. So as we saw earlier in the current ratio, the large increase that we had in current assets from year to year had a tremendous effect on that number. But here for net sales and net working capital, it's working in the opposite fashion. And that's because we had the increase in current assets, but it happened so quickly and in such a short time frame that sales were not able to react. So just for this year, the ratio says that we are not being profitable with the new assets on hand, and we're expecting in future years this ratio to gradually increase and increase because in the future it's pretty safe to say that sales will have a positive reaction to the jump in current assets. So now we're going to check out three profitability ratios, the last type of ratio shown here in this analysis. And what these profitability ratios do is that they measure how efficiently a company turns business activity into profits. The first profitability ratio we'll look at is return on assets, which is how effectively management's invested capital translates into earnings. So it could also be called return on investment. To calculate return on assets, you take profit over taxes and divide it by total assets. Since WWE increased both of these numbers by about the same rate in 2016, they hover around 9% for this ratio, which is solid compared to the industry. And hey, we're beating the industry leader, Cinemark, in this ratio. So anytime we're doing a little better than Cinemark, that's a positive takeaway. So now I'm just going to quickly focus on Regal Entertainment's return on assets, because if you were looking at each of the four companies in the last slide, you may have noticed that their number was significantly better than the others. So it's kind of weird to see that Regal has been performing poorly in the other ratios where all of a sudden this one goes through the roof. And the reason for that is, even though it may seem like Regal is being very profitable with their assets, you'll see on the next slide that their investment in assets are way too excessive, considering the fact that they have negative equity for 2015 and 2016, which means that shareholders are losing money for their investment in the company. And that's just a great example to show how return on assets and return on equity can be interrelated, and how investing too much in assets and maybe having too many assets on hand could actually be detrimental for your company. So now we're going to switch gears over to return on equity, which is the same calculation as return on assets, except total equity replaces total assets. And like return on assets, we can be pretty pleased with the status of the ratio. The increase tells us that they are profiting off of their shareholder investment, which WWE cares so much about their fans. So that's something they'd love to hear. And the reason it increased by such a strong percentage is that we were able to increase our profit before taxes with little shareholder assistance. So that means, unlike the movie industry competitors, shareholders for the WWE are not spending their time and money just to hope and pray their company's profits will react in the same manner. And once again, Regal's figure, which does not look very positive at all, shows us what can happen when too much money is tied up in assets and too much is relied on external financing and other liabilities. All right, the final ratio I'll be presenting to you is a very important one for most companies, and that's the gross profit margin ratio, which is taken by dividing a company's gross profit, sales minus cost of sales, by their sales revenue. And it measures how effective a company is in providing their product or service within their business model. And clearly, this is a ratio where WWE is struggling compared to the movie entertainment industry, lying about 20% below the industry average. Now, the one positive takeaway is that they increased their gross profit margin by the highest rate from 2015 to 2016, and their sales also increased at a very nice rate. So that leads us to believe their cost structure is looking a little shaky. So maybe a long-term objective for improving this ratio will be management looking to control the company's costs. So now just a few conclusions to draw from this ratio analysis just to finish up here. So even though the movie entertainment industry is not WWE's most direct industry or strategic group, most of the sports organizations WWE would directly compete against didn't have any publicly released financials. They were still able to hang tough financially with the best that the movie entertainment industry has to offer. So that's, I mean, pretty impressive considering WWE doesn't really focus on these companies. And if they do focus on these companies, definitely we need to watch out for Cinemark because they were right up there with WWE. And one suggestion we might want to make looking forward for the WWE is making sure we find a way to take all these new current assets that we have and use these to increase the profits and maintain this annual gradual increase that we see in sales.